Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, October 23rd. Risk appetite was hit yesterday by renewed trade tensions between the US and China. Oil is up on fresh sanctions against Russia. Then the disappointment after Netflix and Tesla results this week don't improve risk taking, but barely have an impact on AI appetite altogether. AI that actually powers today's market rally. So what's next? We will talk about all that and more, but before we do, please keep in mind that opinions are my own and this is not financial advice. So yes, trade worries resurfaced yesterday. They did resurface instead of easing. Surprise on news that Trump administration is considering restrictions on software exports toward China. Well, we are not surprised, obviously. This on and off news and hectic headlines about trade are going on for almost a year now, and they will continue. And they will continue to inject some short-term anxiety in the markets without long-term implications, probably. So this is what happened yesterday. Major US indices retreated, led by technology names. The fact that Netflix actually tanked 10% yesterday after releasing its quarterly results and after disappointing investors. But in fine, Netflix isn't an AI play, so the narrative around its earnings story remains very much isolated to them and won't impact appetite for AI and hence for broader major indices of the US that are carried higher by AI bulls. Elsewhere in the earnings front, well, Tesla missed expectations yesterday after the bell, and that despite record vehicle sales. Now, record sales because buyers actually rushed in to buy EVs before the end of the federal subsidies, a one-off jump probably, which will hardly prevent Tesla from printing a second year of sales decline. And profits plunge at Tesla despite record sales because the company's operating expenses jumped 50% on rising costs, and that was partly due to Trump policies, $400 million to put a number on the cost of the duties. Now, obviously, it's hilarious to think that Elon Musk spent massive amount of money to support Donald Trump's election campaign, and this happens. But what do? It is happening right now. Trump is not a climate man. He never has been, and the subsidies are out of the window now. So what's next? There has been always a way for Elon Musk actually to turn the company's fortunes and the narrative around Tesla around, and he now focuses on AI, on humanoid robots and robo-taxis. The problem here is that, well, they have been exciting for investors for a while, but these businesses won't make up for the revenue loss of EV sales. And for once, investors yesterday didn't look convinced that they should buy the Tesla dream anymore. So bad results at Tesla led to a 3.80% slump in the shares price in the after hours trading. Now, looking at the Tesla chart broadly, Tesla has been on a wild ride since the US elections last year. Well, the EV business is under pressure since last year. We know that, and is far from delivering the 50% annual growth that Elon Musk had promised years ago. Remember, that was the beginning of this Tesla hype. We are instead heading, as I said, toward a second-year decline in sales. But the man, Elon Musk, was very, very successful indeed in turning the attention away from the EV sales to AI, robo-taxis, and humanoid robots. Then last year's US elections and his friendship with Donald Trump boosted the stock price, remember? And then that friendship unsurprisingly ended and the stock price fell, and it is up now again. But this company trades with a PE ratio of more than 300, to say how speculative and how far from reality it is, even compared to the other magnificent 7 stocks which have an average of 33 of PE ratio. So what Tesla needs today to deserve this valuation is to get the robo-taxis, the robots, and the AI right and start getting revenues from it. There's a chance, but there is also the Elon Musk risk factor that makes Tesla quite a different bet than for other technology names of the moment. And as for Netflix, well, Tesla happily doesn't mean much for the AI narrative just yet, and that AI narrative is what powers or what could reverse the broad market rally. So major US indices are up this morning despite these disappointing earnings from Netflix and Tesla, and sentiment looks okay despite looming trade, geopolitical, and credit risks. So we spoke about the trade risk. Now let's speak about geopolitics. The European Union approved its 19th sanction package against Russia, if you mind, while the United States yesterday announced sanctions on Rosneft and Lukoil. So those are two Russian oil giants. And actually, the news are helping to push US crude higher this morning past the $60 per barrel psychological level. Now, note that the geopolitical headlines of this kind tend to generate short-term price pressures, short-term price moves toward the upside. So the tactical long positions here will likely bump into offers near the $62 to $62.5 per barrel level. That actually includes the minor 23.6% Fibonacci retracement level on June to October sell-off in US crude and the 50-day moving average. But the medium-term outlook remains somehow bearish for oil on the back of uncertain global demand due to trade tensions and ample supply. So the upcoming Fed rate cuts on the softer US dollar should, in theory, help throw a floor under the oil sell-off, along with this massive energy needs for AI and for technology. Yet oil bulls, well, could barely make their voices heard over the past few months on these arguments, and speculative bets in favor of oil are also retreating. So in summary, I believe that any price recovery that we might see in oil will remain short-lived, and the medium-term outlook for US crude will remain bearish below the $65 per barrel level, which is the major 38.2% Fibonacci retracement on the summer to October sell-off. And speaking of credit risk, well, worries about bad loans, bad credit that surfaced last week in the US are mostly over and done, with multiple US regional banks reporting no more cases, no more cockroaches in their quarterly reports. That is obviously very good news, but the latter stress comes as a warning that credit markets are not in a super good shape. And on the wire again, yesterday, while Primal Land Capital Partners, which is a subprime auto lender, filed for bankruptcy, as low-income Americans are now falling behind their car loans at the highest rate in decades. That's not a good thing. But the thing is, we know that the stock market's performance, especially in the US, isn't representative of the US economy. We also know that the US growth numbers are masked by massive AI investments there. We know it because the jobs market, for example, is not going so well, is well weakening these days, and things are about to get uglier before they get better in the US, as many federal employees will probably not be receiving their paycheck next month because the US government is shut. And well, this time around, this government shutdown in the US is on track to be the second longest in history. And there are news on the wire that some banks will be out there to help people. So the conditions are clearly paving the way for it. Federal Reserve help here, this is what I'm trying to say, but the Fed can help only and if only inflation doesn't pick up too strongly, because we're already at 3% level, which is way above the Fed's 2% official target. So we'll have the answer on Friday on the CPI metric, but the US 2-year yield that best captures the Fed rate expectations confirms that investors are now positioned for at least 2 more interest rate cuts in the next 2 Federal Reserve meetings. And guess what? That per se is positive for risk appetite and valuations. So I will leave it here today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
This content is intended for individuals who are familiar with financial markets and instruments and is for information purposes only. The presented idea, including market commentary, market data, and observations, is not a work product of any research department of Swissquote or its affiliates. This material is intended to highlight market action and does not constitute investment, legal, or tax advice. If you are a retail investor or lack experience in trading complex financial products, it is advisable to seek professional advice from a licensed advisor before making any financial decisions. This content is not intended to manipulate the market or encourage any specific financial behavior. Swissquote makes no representation or warranty as to the quality, completeness, accuracy, comprehensiveness, or non-infringement of such content. The views expressed are those of the consultant and are provided for educational purposes only. Any information provided relating to a product or market should not be construed as recommending an investment strategy or transaction. Past performance is not a guarantee of future results. Swissquote and its employees and representative shall in no event be held liable for any damages or losses arising directly or indirectly from decisions made on the basis of this content. The use of any third-party brands or trademarks is for information only and does not imply endorsement by Swissquote, or that the trademark owner has authorized Swissquote to promote its products or services. Swissquote is the marketing brand for the activities of Swissquote Bank Limited, regulated by FINMA, Swissquote Capital Markets Limited, regulated by SISEC, Swissquote Bank Europe SA, regulated by the CSSF, Swissquote Limited, regulated by the FCA, Swissquote Financial Services Limited, regulated by the Malta Financial Services Authority, Swissquote MEA Limited, regulated by the Dubai Financial Services Authority, Swissquote PTE Limited, regulated by the Monetary Authority of Singapore, Swissquote Asia Limited, licensed by the Hong Kong Securities and Futures Commission, and Swissquote South Africa Limited, supervised by the FSCA. Products and services of Swissquote are only intended for those permitted to receive them under local law. All investments carry a degree of risk. The risk of loss in trading or holding financial instruments can be substantial. The value of financial instruments, including but not limited to stocks, bonds, cryptocurrencies, and other assets, can fluctuate both upwards and downwards. There is a significant risk of financial loss when buying, selling, holding, staking, or investing in these instruments. Swissquote makes no recommendations regarding any specific investment, transaction, or the use of any particular investment strategy. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. The vast majority of retail client accounts suffer capital losses when trading in CFDs. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Digital assets are unregulated in most countries and consumer protection rules may not apply. As highly volatile speculative investments, digital assets are not suitable for investors without a high risk tolerance. Make sure you understand each digital asset before you trade. Cryptocurrencies are not considered legal tender in some jurisdictions and are subject to regulatory uncertainties. The use of internet-based systems can involve high risks, including but not limited to fraud, cyber attacks, network and communication failures, as well as identity theft and phishing attacks related to crypto assets.